Well, I think the taxation question is a little bit double-edged sword, right? Because there are some policies that are being proposed that are quite favorable for equities and companies if there's tax cuts. And then also for the consumer, if there's tax cuts, some of those policies be quite favorable as well. But to your point, it does raise suspicions in the bond market. And the bond vigilantes are watching very closely about, hey, how much more debt can the world sustain to keep interest rates, particularly on the longer end of the curve, when it comes to interest rate levels. And so we do have concerns that we could see a continuation of steepening in the yield curve, more term premium priced in, particularly if there is larger amounts of fiscal spending and unconstrained tax revenue as it goes down, and we start to build up more debt levels across the world. And I do think we are underpricing term premium the further you go out on that yield curve when it comes to bond yields.
So underpricing term premium? So are we talking,
Yeah.
we could see what, 5.5 on the 10? 6?
So, yes, I think that is a risk. If we continue to see policies that increase potential debt burdens, whether it's in the U.S. or around the globe, we already have very high debt levels of debt. And term premium, as we know, the yield curve is pretty flat these days. If you go back in history and you look at where term premium is, historically speaking, and you look at some of the policies on the table as well as just the outright levels of debt these days, there is a plausible scenario where you could see 10-year yields go towards 6% in the United States.
Okay. So here's the thing, if there is that risk, right, that the term premium could blow out even further, 5.5, maybe even 6, what kind of position is that going to put the Fed in? Because you are more or less handicapping, the Fed put that's still going to be there, which should theoretically be, go for equities, right? But you could also argue that if you're looking for 5.5, 6 on the 10, Fed may have to U-turn and could even start having to hike. I mean, which is more likely to happen, do you think, under a Trump Fed?
I think both can technically happen. I think we can have an environment where the Fed does still continue to normalize rates towards a neutral policy, which is a handful of percentage points from where we are today, and at the same time see a moderate increase in the term premium and higher rates in the longer end of the curve. Now, will equities care? They will care at some point in time, but I think equities can and have historically been able to stomach a yield at a higher level in the 10-year or longer while still having a more traditional curvature to the yield curve with short-end yields coming down. So we do not think this is a death nail for the equity markets, but we also think there is enough potential supply in the market when it comes to bonds that there is a risk that you could see higher yields on the longer end of the yield curve.
So, Nathan, I almost hate to put you in this position, right? But we're usually kind of obliged to ask these kinds of things, right? So I guess the question is, look, are we? What is the likelihood of a three-peat? We're coming off the back-to-back plus 20% years, but this year?
I think it's very low that we'll see a three-peat. Our consensus view on equities is you might get a S&P 500 in the 6,500, maybe slightly higher than that. So we are seeing positive equity returns for the U.S. by the end of the year. The consensus by a lot of people in the market is even higher than that. And I think the higher volatility, potential uncertainty, and given where valuations are already, I think it's very difficult to warrant another year of 20+% returns in U.S. equities.